we're not the only ones paying attention to mortgage rates and what's happening in the housing market. So is our friend Jerome Powell over at the Fed. And certainly they're a big player in the discussion about markets and economy this year. And one of the questions we're getting a ton is, is the Fed done? As we say around here at Albion, have we reached peak Fed? So to Jason or Mike or whomever would like to go at this first, what are we thinking about rates and monetary policy? And do we think the Fed is done hiking?
So I'll lead off with the top of the funnel monetary policy and Fed perspective. So as we said in July on our last conference call, we think the Fed's done hiking in the cycle, unless inflation or inflation expectations reaccelerate, or workers' wages pick back up due to a relentlessly tight labor market. And again, our base case is that the labor market is normalizing. Unless those things occur, they're very likely done. And when we listen to Jerome Powell speak, whether it's at the press conference after an FOMC meeting, or whether it's when he's giving a talk or moderating a conference at the New York Economic Club, whatever it may be, Powell sounds like he wants to be done. I think that they think they've done enough. And the data largely supports that, namely the inflation data. So they'd probably like to just sit back at this point and let the monetary policy lags do the work from here. Again, going from 0% to almost 5.5%. At the same time, bond yields have done some of the work for them since the last time they raised rates in July. The 10-year yield, the 10-year Treasury yield, is up about 2/3 of 1% since then. It was up over 1% from those July levels until just recently. So the general message is we've had a lot of financial tightening in the system. And while they can't yet say mission accomplished, things are certainly on the right course in terms of their battle against inflation. So yeah, we think they're done.
I'll jump in real quick too, just to point out that futures markets, and I think many of our clients are aware that there are futures markets for overnight interest rates where there's essentially an implied probability based on where those futures are trading of additional rate hikes or rate cuts or what have you. And over the last couple months now, really since the last time the Fed did their last rate hike, there's been sort of a debate within futures markets of the probability of one more 25 basis point rate hike. As of yesterday, after we got that CPI print, the implied probability of another rate hike is literally zero. And it's the first time. I have it on my screen in front of me right now. It's literally 0.0. So any sort of remaining notion that market participants might have had that, okay, we might still get one more rate hike, that is gone as of yesterday.
And I'll add 2 points that I think are interesting. The first is always remember that the Fed wants us to think that there could be additional rate hikes in the future, because that alone helps dampen the expectations for future inflation. It helps them. So you may hear some scary things come out of the Fed, but that's by design. If they do that right, they may not actually have to hike the rate. The second thing is Jason mentioned the 10-year Treasury. And I think looking at what the rate is on the 10-year Treasury is really interesting for all of us, because that gives us expectations of what investors think inflation is going to be like in 10 years. So the Fed controls the short end, controls the short term rates, but they don't control the 10-year. And Mike, I know you and I and with the whole investment team have had discussions. Share with the audience just how much the 10-year rate has dropped since the October high in the rate there.
Yeah, about 0.5%. It's this year in general, there has been a lot of volatility in interest rates, not just this year, the last several years, because of inflation and what the Fed's been doing. But even just the last 6 weeks, like if you go back to late September, 10-year Treasury was around 4.5%, which is roughly where it is today. And then in a very short period of time, it went up by 0.5% and got as high as almost 5%. It never actually closed above 5%, but it did trade there intraday very briefly. And then just in the last couple of weeks, that 0.5% that it increased has come right back out. And so now we're back down to about a 4.5% on the 10-year. And I mean, our kind of longer term view there with respect to, where rates writ large are going? The answer is probably a little lower if we're right about inflation and the Fed gets that back to its target. A sustainable kind of 10-year yield is probably more in the 4% range ish, not necessarily 4% plus, which is where we are now. So there's a little bit of room for longer term rates to come down, but much like I said with mortgages, no expectation that we're going back to ultra low interest rate environments like we were in for a couple of years out after the pandemic.